This is our high risk warning, guys. There it is. Trading foreign exchange stocks, options, or futures on margins carries a high level of risk and may not be suitable for all investors. Before you decide to trade, you should carefully consider your objectives, financial situation, your own personal needs, and your level of experience. The speakers on Traders on Trend and the Summer Market Summit provide general advice that does not take into account your own objectives, your financial situation, or your own personal needs. So this is all, it's all general advice, guys. The content of this webinar should not be construed as personal advice. You could lose money. I mean, everyone should know that. If you don't, like every one of these speakers has really gone out of their way to tell you there is no get rich quick way in the stock market. There's a grind. There's a learning what you're doing, increasing your education, knowing what tools to use, when to use them. They're all saying the same thing to you. And I think that a lot of us, especially us guys, us men, we're always looking for that quick way to get rich and change our lives. And I think it's it's a fun thing to think about. But the truth is that there is no quick path. But if you find the right mentor, you find the right guru that can kind of teach you, it can really help you a lot along the way, at least in your education. Now, our next speaker, he spoke with us back in February at the I Love Trading event that we had. And I actually met with Larry a couple of months ago. True gentleman, Texas gentleman, super nice guy, and actually incredibly knowledgeable. He is going to tell us today how to trade extreme market. How to trade extreme market. That's a typo. How to trade extreme markets uncertainty, low risk, high return option strategies, butterflies, and long condors. Now, we heard Jeff talking about the long condor in the last presentation, but he didn't go into the details. But today, Larry's going to do that. He has over 30 years of professional trading experience, including serving as an executive vice president and running the international trading desk for a major oil trading company, which is pretty cool. He founded PowerCycleTrading.com in 2010, and Larry has taught literally thousands of traders his directional option trading process. Larry provides top-notch trading education based on a proprietary directional trading model and option trading strategies designed for high returns and low defined risk. And what that means is this isn't something that he's copied off some book. This is Larry's own proprietary, which means it's his strategy. Larry's committed to sharing his extensive knowledge and experience to help traders reach their financial goals. He's an incredible educator, and we're super thrilled to have him here today. Larry Gaines in the house. Larry, how are you, buddy?
Hey, great. Thanks for having me here today, John.
Oh, we appreciate you coming, man. We really do.
Hey, Larry.
Right. Hey there, Rod. You want me to switch to my screen?
Yes, sir. It is all yours.
All right. Thanks. Let me find it here.
Good luck to you.
We're going to drift off into the background. If you need us for something, just give us a holler.
Make sure I've got everything set up here properly.
Boom. I see it.
All right. Let me get my chat open. Just bear with me.
That's okay, Larry. I'll fill some time by letting people know. Guys, we do have the chat open today.
Okay.
You guys can chat amongst yourselves, or you can ask Larry questions, and he'll be more than happy to jump in and answer them for you.
Okay, I'm ready. So hopefully everybody can see my screen and hear me loud and clear. So again, thanks very much for having me here today. So what I'm going to go over and talk about is, two really great strategies for any kind of market condition, but great for kind of really market uncertainty, extreme uncertainty as well. But, when we're trading, we're always in uncertain markets. So these are two strategies that can really be a really big complement to your trading portfolio, offering low risk, high return type trade setups, for your portfolio. So let's get started. So just to get this out of the way, the following presentation is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So I've been trading options now for over 30 years. And what I've found is that the most valuable go-to option strategies that can literally help any trader more than others, and especially during extreme market conditions or uncertainty, are two strategies called the option butterfly and the long condor. So this was from one of my members, and it's so true. He said, the butterfly strategy is one of my favorites. It's the big winners that eventually make the difference in any trading account. So an account without a potential for a big one once in a while not betting the farm is a slow ride up a long hill. but this strategy is absolutely like easy as ABC. So that's a really great point, because this is a strategy we'll talk about, the butterfly, which gives you the potential for the big winners, but not betting the farm. So you get a better equity curve going up, and occasionally you're going to get one that's the big home run. So I'll show you a bunch of different ones, and you'll see what I mean after we get through this presentation. So the huge advantage, though, of these strategies is their unique option framework that's designed to take advantage of both time decay, theta, and volatility, which are the two main option pricing components. So this is going to help to stack the trading odds in your favor, and it can be used in any type of market environment. It makes them really favorite when trading more high extreme market volatility and uncertainty. So if you just know when and how to use them, they're going to be one of your best trading tools that you can jump onto. So because they are structured, again, for only a small amount of your hard-earned capital at risk, the returns can be very explosive, and sometimes like a lightning in a bottle. It's like one of those kind of trade setups that you want to just bottle up and do it over and over and over. So like lightning in a bottle, I had one of my bosses, when I first got into the trading end of things, he would just get all excited and say, gosh, this is like lightning in a bottle. So I never forgot that. Now, the butterfly and the long condors, they're also very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So, in other words, if you learn how to trade these two strategies, you can be covered for both your offense and your defense. So goals and protection. So, you can set these up for great potential profit returns, but they're also great for hedging. So they can work no matter what the markets are doing, up, down, or sideways, can provide income from stocks that are going nowhere, really helps to eliminate the stress of having to be perfect on your stock direction or overall market, eliminates the time decay expense that's encountered from long decaying options, and really takes the unsettling guesswork out of your trading. So these can also be structured for very low cost or low capital at risk type trades, which can literally offer you potential returns of 10 to 1 or higher, on a reward to risk standpoint. So that's what's really excited about them. You'll see some that are just so low risk, but they're what we kind of call lotto trades, because they can offer such a great reward or return on that capital that you're putting out there. Now, when we look at the butterfly long condors, they're also used for hedging. So when you mess it up, this is a really fast way to cover your pronto when a position starts to move against you. And I've literally found no other hedging strategy that comes close to implementing these types of strategies around a core position. Now, by constructing either a butterfly or a long condor around a strike that is under pressure from another core trade, such as if you're doing credit spreads or debit spreads, it's a really great way, and the best way that I've found to immediately not only neutralize, but lower risk. So if you've done credit spreads, you've probably been in a situation where it goes through your short strike and, you're underwater on it. But this is one strategy that can really help to alleviate this. And this was from one of my members, Pam. She said, wish I'd known how to do this hedging before I lost so much money doing credit spreads. So that's really true. And we'll talk a little bit about this as we go forward. Now, the complexity, they're very simplistic. They're just based on vertical spreads. So in this example, this is like a call debit spread. You can do, calls or puts, but this example is like a call. So let's say you have a call debit spread. So you're long a call, short a call. And the cost of this trade is your debit paid of 300. So in this example, you're say long this 1010, just like the NASDAQ 100 call here, and then you're short against the 1020. So $10 wide spread. So that's $1,000 wide spread, as per an option contract. Your cost of the trade is 300. So the potential on this trade is a nice potential return of the difference between that would be $700. Now we can easily hedge this and reduce that risk quickly by adding another vertical spread to it in basically the opposite direction. So if I wanted to, I could just adjust this down to literally, no risk. This would be down to $100 by adding this additional credit spread. So selling a call that 1020 and then buying the call above it to cap that risk. And now I've brought in $200, which is going to reduce down the risk from the original debit spread. And now I've got this trade totally neutralized and lowered the risk to 100. And have potential. This is what really makes it a great strategy to give you those big home runs from time to time. So now we've gone from the 300 potential cost of the debit cost of that credit debit spread And now we've converted this to the credit spread by adding that and brought in $200. So risk now is reduced to $100. And if it goes out at the what we call the top of the tent, this is the max profit. And in this example, if you have $1,000 wide spread, now your cost of 100, your potential return is the difference of 900. So that would be a 900% return. But even if you don't get the full max profit, you've got a really good profit zone all the way in between here. And you can just see how big your returns are on that capital you're putting up. So that's why a lot of times I call these kind of a low stress option strategy as well. Now, the long condor is similar to the butterfly, but what we're doing is spreading out the strike, the profit zone. So instead of doing the butterfly and having kind of a narrower zone where you really have to thread the needle, we're going to stretch that out and create what we call a long condor. So, but this is different from the iron condor. So the iron condor, just to make it clear, sounds the same, but they're totally different animals, and they look the same as far as the risk profile. But when you're doing an iron condor, you're basically two credit spreads. Okay, you're short a call credit spread, so that call credit spread, then you're short a bull put credit spread, like that. So your potential profit is just the credits received. So let's say you had $50 credit here, $50 credit there. The max profit on this would just be $100. But the condor is the difference between that, is because it's a debit spread with a credit spread. So you've got a reward to risk of 2 to 1 up to maybe 4 to 1 versus a negative risk ratio on an iron condor. So it's a huge difference. I just want to point that out. So that's a long condor, and we'll talk a little bit about that. But they're really cool. These are really, and they're also kind of fun trades to set up because the potential is really out there for these trades. Now, the core concept that make the butterfly and long condor dynamic is basically the option pricing components for profit generation. So when we break it down, it really comes down to understanding how option pricing works and the concept of time decay and theta and its effect and impact on the price of your option. So let's kind of take a quick review of this kind of course concept so you kind of understand what we're trying to take advantage of. Now, theta, what it does is it tells us how much an option price will go down over time. So it's the rate of time decay of your stock's option. And time decay is going to occur because of the extrinsic value. That's the kind of the time decay component of it, the extrinsic value of your time value of that option. So it's going to diminish and go down each and every day. And as you get closer and closer to expiration, it really accelerates. And at the end of the day, an expiration date, it goes to zero. So that's what we're taking advantage with on butterflies and long condors, that sell side component. But we've also got the other side, which gives us the potential for the big profit. So here's just a quick example to kind of show you the math. And so these can be, short duration. They could be actually 1 day up to 2 weeks is kind of the duration point that I like to look at. And they can be very, very, small target type trades or larger. So this one is just an example. XYZ is trading at $45. We're just looking for a small move down to 43. So what I'm going to do is set the body of my butterfly at the target where I think it's going to go directionally. So I've got the body of the butterfly. That's where it gets its name from the short strikes there. So I'm long the June 44 put, and then I sold the 43 put, brought in $1.67, sold another 43 put, brought in $1.67, and then bought the 42 put. So I've got, you can see it's a dollar wide spread between each. So you can really narrow these based on the spread width. So the total cost of the trade is your debit cost of $238 here, plus the debit cost there of that 42 put, and then your credit that you brought in from those two shorts that you sold from the body. So your total cost on this trade is 10 cents or $10 per option contract or butterfly. So you can really narrow these costs of your capital down, by controlling the width of your butterfly. And that's how you control the risk to reward. So then your profit is just taking that middle strike less the lower strike, less your debit cost, and that's going to be your potential profit. So in this case, 43 less 42, less your cost of the butterfly. So it gives you a potential to make 90 cents or $90 for that butterfly trade. So that's, basically you're risking $1 to make $9 versus with credit spreads, it's always a negative risk ratio. You're going to be risking, $6 or $7 to make $1. So you can see the huge difference in the impact this can have on a trading account if you add this to your account portfolio. So the next question comes then to how do you choose the best butterfly or long condor, for your specific trading goals. So, what I always look for and tell my members is the goal of every trader really should be to select trades based on what's going to give you the most consistent positive returns over time with low defined risk and not always that greatest kind of return. So what I look for is just kind of, singles and doubles chipping away. And then occasionally you're going to get that kind of home run. So we'll take a look and see, and I'll show you kind of what that amounts to. And one of the best ways to achieve this is by being aware of the different option strategies that are out there and available, then understand how they work, and then select the one that's going to be best suited for the market environment you're trading or your specific trading goals. So these particular strategies, you can do it as a small retail trader. You can do it with one lot, or you can do it with thousands. We've done these when I was set up an over-the-counter brokerage desk for an oil company. We did literally thousands of these butterflies on, using oil futures. So the size is unlimited, but you can do it with small and get in and out pretty fast. So they're pretty cool for the small retail trader like ourselves as well. Now, when we look at the butterfly, I kind of call it the butterfly family. So we've got a number of different variations, and they all have the component of selling time and volatility. So we've got we can do long call or put butterfly. So we can directionally shape a move up using calls or move down using a put. We've got what we call the broken wing call or put butterfly. We've got the ninja, which I kind of refer to as a ninja. It's an unbalanced or ratio butterfly. We have an iron butterfly, and then we have another category, just hedging. So defense strategies that incorporate using the butterfly, and then kind of what I call the cousin of the butterfly, the long condor. So we'll go through a bunch of different examples, and you kind of get a better feel for exactly how they work. Now, let's take a look and a review. And one more thing to point out is we can adjust the risk and reward or risk to profit using the wingspan. So a good analogy is if you've ever, looked to collect butterflies, or maybe even collect, butterflies. If you use a small net, it's going to be very hard probably to catch one. But if you widen your net, get a bigger one, you're going to have a lot easier time to catch a butterfly. So we can do the same thing with the butterfly. So we can, if we want to really make our risk very, very low, we can narrow the butterfly, the wingspan. If we want to get a big profit zone, we can widen that wingspan. So we can do that and really create different variations for our risk to reward parameters that we're looking for. So the first one I'll show you is our very narrow wing butterfly. And these are great for ETFs, SPY, QQQ, IWM, the Russell, Dow, whatever, and they're also great for index options, SPX, NDX, et cetera. So here's just an example of one that was a very low, narrow width spread on SPY. So with this strategy set up, I'll kind of walk you through it to kind of visualize what we're looking at. SPY was trading here like on the 14th, and this was for expiration just 2 days later, very short duration. I like to use Fibonacci kind of to set what I call my profit target points or defense targets. So Fibonacci plus moving averages plus any option activity gives me really good target points. So this, from the swing high to low, we had a really nice target here, that 618 retracement coming in about 273, 274. A lot of option activity here in this moving average kind of area there. So we set up a butterfly just targeting this area right here. And so our target was 273. So that was going to be the body of our butterfly, that target. So let's go through what this would look like. So what we did was we set the trade up. It was traded at 267. So we were targeting up there to 273. So bought the 272 call, sold the 273, sold the 273, bought the 274. So dollar wide. So very narrow butterfly here. So that had the risk down to 10 cents right here, which is $10 per butterfly option spread. Now your spread on the trade was $1 or $100 less that $10 debit. So potential profit is $90 per butterfly, or that would be a 900% return. So risking $1 to make $9. Now this one actually ended up making $70, but that's still a 700% return. So you can see the huge, benefit that you get from this, adding this to your trading portfolio. You're chipping away to singles, doubles, and then occasionally you'll hit it 700%, 900%, or even greater. And then, you can control the dollars that are coming in by the spread width as well. So that's just a really good example of a very narrow wing butterfly. And let's take a look at the risk profile. So here it was going out on expiration. And this was on the 16th, which was the expiration date. And it was going out at 173, very, very close. And then you can see in that area there, that black area is still what's left of profit. So with the butterfly, when you take it off, if you waited all the way towards the close, you might be able to pull the balance of that out, but went ahead and we had this one close it out there. So this was up, then it went from 10 cents or $10 to 80, okay, on the spread. So there's your profit of $70 per spread, which is a return of 700. So on this one with 4 contracts, that's, up $280 on your risk of $10 per contract, $40 at risk. So super great strategy for any size account. So that's a low, very narrow. Now, what we primarily do will be what we call these wider wing butterflies. And this is where we can widen out the profit zone. So again, these are going to be structured for defined risk. One second here. Yep. So structured for defined risk and hedging. Use what I call for targeted directional swing trades. Used for pinning. That's where it goes out a certain strike at expiration that we're looking for potentially to go out, at that strike. We call that pinning. Great for high volatility markets, because when we get in high volatility markets, we are selling the volatility of the spread. And when that goes up, we're getting more premium to come in. So also really great for trading at high price stocks, which I'll show you an example of. So, back when Amazon was trading over, $1,000 and stuff like that, it was very hard for most retail smaller traders to, participate. But with the butterfly, you can easily trade stocks that are really high priced. So we'll look at a couple examples there. And then the trade duration we tend to look for is anywhere from 1 day out to 2 weeks, is about as far out as I like to go based on the structure, how they work off time decay and volatility. These are always going to have positive data, so no theta decay, no time decay, and you'll get returns of 10 to 1, 10 to 1, 2 to 1, 10 to 1, sometimes even higher, you can see. So let's go through some examples here. So here's one. These are all trade examples from my trade room or my alert service that I have at Power Cycle Trading. So here's one that we set up on a short side. This was QQQ, and this was doing a wide wing put butterfly, which was $10 wide or $1,000 per spread. So just kind of going through the setup and why it was set up. It was trading at, on the 23rd here, it was trading at $314.60. So right in here. So we were looking for a downside target into this area down here, this 310, and then potentially lower. But we were using this Fibonacci level coming in here, that 382, and then we're going to, go from that point and see where we would go. So my momentum indicators are negative. This is my trading model that I use. I had a cycle reversal. So, all the indicators we look for were pointing down. So we did this trade setup to give our risk low, but give us a potential really good leveraged return. So here's the trade setup, what it looked like going in. And again, this was set up on the 23rd. The expiration was the 26th. Okay. So just a 3-day to expiration. So we were targeting down to the 304 area. Now, so we set the butterfly up. At the time, it was traded at 314.60. So we bought the 314 put, sold the 304. So $10 wide right there. And then sold the 304, bought the 294. So we had this butterfly spread up, put butterfly that was $10 wide or $1,000 less the cost of the trade, 210. So you can see here, $2.10 or $210. So the difference is your potential profit of 790, which on your risk of 210 would be a 376% return, or again, positive risk ratio, risking $1 to make 376. Now, if you had just sold shares of an ETF and you hit that target, you would have been up $10.60 a share, but look at your return, only 3.36% return. So huge difference between what you get as far as your risk reward and the capital you put out. So that's what it looked like going in. Now, here's where it was going out. and you can see the butterfly. Looks like the butterfly. Here's the top of the tent right there. And it was going out right here on the 26th at the 306.17 right there. So we didn't get it totally exactly at 304, but came very, very close. And so this went from $2.10 or $210 up to $7.82. So that was our profit there on that. And that was up $572 per spread, or 272% return versus the shares if you did those at 3.6. So great trading advantage of taking advantage of time decay, volatility collapse, low defined, high reward risk type trade setup. Now your risk here is 210. So what I'll typically do, I'll have a defense trigger based on a break of a key moving average maybe, or fib level. Or what I'll a lot of times do is I'll take 50 to 60% of the debit cost and use that as a stop loss, whichever occurs first. So, you're not going to lose the full 210. You might, if you did 50% of that, you'd lose $1.60, something like that. But, based on the trade setups, based on our, trading model, these are very high reliability trade setups as well. But that's what gives you the big potential return. Now, here's a really cool example that I wanted to show. And this is on Amazon. So this shows you how you can trade, great for trading really high price stocks with very low risk using this directional wide wing butterfly. So here's an example back when Amazon was trading over $1,700, almost $2,000 a share. So with this example, we were coming in here, we had a good support level right here at about 1782. And we were looking for just an upside target to this 1830 area, which was a kind of what I call price action resistance and a moving average resistance. So if you think about this, one option contract's equivalent to 100 shares. So if you went out and you bought 100 shares of Amazon when it's trading at 178.2, you're going to be putting out a capital of $178,200. So that's a huge amount of capital at risk, right? And even if you get the trade set up right, your return is very, very small, but look at your potential risk. Okay, so we can do the same trade though, pushing for an upside directional trade, and we can do this using the butterfly spread at just a fraction of the cost. So we were looking to, we did hit the target on the expiration at 1830. So let's walk through, and I'll show you how dynamic these are based on the, theta decay and volatility coming out of the trade right into expiration. So here's the setup, so you can see the profile of it. So we're, again, targeting, our price target is 1830. Now, if the stock had traded and made it to that price and you'd paid, 178,000, whatever, your share profit was 48 per share. Look at your return, only 2.69. But by targeting this 1830 using the butterfly, so there's our body of the butterfly. So it was trading at 1782. So we went out and bought the 1820 call, sold that target of 1830, sold the 1830, bought the 1840. So that's a balanced butterfly, $10 wide. So we've got $1,000 potential. Look at the cost of the trade, 80 cents or $80 debit. All right. So less that $80. Now, potentially, if you nailed it right to 1830, this trade would be up $920 per spread. That's 1,150% return. So you risk $1 to make $11.50. So these are actual, of all the different option strategies that are out there, option spread strategies, the butterfly will give you the highest return on your risk of any spread strategy there is. So just keep in mind, 1,150% return. So if somebody said, BS on that, these are actual, you can actually make these kind of returns. Now you're not going to always, but just think about it. If you're even close, inside of that, you're still going to have a great return. So that's what makes them great, because, if you're just even inside close to the body of the butterfly, just maybe in here or there, you still have, potential really big returns on your capital at risk, just based on the wingspan of your butterfly. So here it is. This is what I want to illustrate to you. The next is that this was in the morning. So, about 9:30 a.m. In the morning. So at that point in time, on the expiration day, on the 6th, it was trading, Amazon was trading at 1,836. So it was way outside, it blown right through that 1830, and it was trading right there. So this purple line is where it is in time. So even at that price right there, early in the morning, this thing was up $150 per spread. So on one contract, it's 150. So it went from 80 cents or $80 to $2.30. So there's your profit there in the morning at 150. So that's a great return, right? 187% return. Now, this is the beauty of the other great part of the butterfly. If you look at this, area in here where my pointer is, you can see it's all black, right? That's potential profit. And that's at the very end of the day. So if you waited all the way to the end of your day on expiration, it goes back towards your 1830 strike here. You're sucking out that profit from selling time and volatility. That's going into your pocket. So here it is, about 3 or 4 hours later, the same day, and the price has gotten a little bit better, but the main profits coming from that time decay and volatility component coming out of the spread. So here you are at the end of the day, this thing is up 4 times what it was in the morning. So here it is trading at 1832 right here. So very, very little left in the top of that tent because your profit's being sucked out, because at the end of the day, your time goes to zero and volatility goes to zero. And that's a big part of the profit in the trade. You can see here your theta at $33 of theta. That's your time decay. So now the spread went from 80 cents or $80 to that $6.95. So that's up to a profit of $614 or 769% return, versus if you did the shares, you make 2.69% gain on the stocks. So that's what's really cool about these types of strategies. So that's one to take advantage of high volatility market plus high price stocks. Now, these are what we call pinning trades. This is one that we had set up on Google, and this is a long pinning trade. And this one is, one second here, make sure everything's in order. Okay. All right. So what this one is going to show you, what we call pinning. This is where it goes at a specific strike price into expiration. So we set this pinning trade up on Google with a $4 wide spread. So Google was trading right in here, was trading at 95.75 back on the 15th, a couple of Mondays ago. Okay. So right here, we had momentum shifting up. So our directional model was telling us to the upside, and we were targeting this area right here, this level right to here, this $100 strike. So that was price action resistance. And you had this moving average resistance over that. So this was a good target area right there, and a lot of option activity there. So we were targeting this area of $100. So did this pinning trade set up using a butterfly, targeting that area where we thought there's a high probability that it could go out. So what we did was, again, it was trading 95.75. So we're targeting 100. So we did the body of the butterfly at 100. So bought the 96 call, sold the 100, sold the 100, bought the 104. So we had a balanced butterfly targeting 104, spread with $4. So $400 less the cost of the trade, 80 cents or $80. So the potential profit is the difference of between that 320. So that would be, if it hit that, nailed it perfectly, that'd be up 400%, or you risk $1 to make $4. So here it is, the risk reward. So risking 80 to make potentially 320 right there. So let's see where this one went out and show you how it ended up. So this one, was going out. We came pretty close to the pin, but not exactly, but it went out at 101. So it overshot it a little bit. And that was up to that moving average resistance. Let me just back up and you see. So, these are wide enough that you can participate. You don't have to make it exactly perfect. The other thing, see that blue line that was coming in at 101, 102. So that was all factored in. So even if we overshot, we're still going to make a pretty good profit on this. So here it was coming in at 101.12. And you can see it went from our cost of the trade, 80 cents or $80 up to 285. And at that point, it was up $205 on your risk of 80. So that's a 256% return, or you're risking $1 to make $2.56 over a 3-day period. So that's where you get the potential to make these big, huge hits or wins versus just always chip and not making that much. Now, this is what we call a lotto trade or a lotto ticket. And these are really cool and really fun. And this is using the butterfly. So this again is one where we're looking for a pin at a certain price point, and we do it set up the trade by butterfly. So this is one that we'd set up in the room, and this was a long call butterfly on Tesla. So this was back on the 15th on a Monday, and Tesla was trading at 166.50. So we were looking for an upside target at 180, and it went out very, very almost to the penny. So we were looking for an upside target here to 180, and this was again based on option activity, based on Fibonacci level. See this Fibonacci at 50% retracement. So Fibonacci level, moving averages right there, and a lot of option activity. So it was a really strong profit target. Our target we're looking at right here for 180. So we did this with super low risk. So if we're wrong, we're not going to lose much at all. So this trade setup was, you could have put this trade we set up at 40, but this thing was at 1.30 cents. So here was the trade structure again. So the expected move was about $9 up. So that was going to put us very close to that 180 strike when it was trading right there at 166. So our price target was 180 based on a lot of option activity, key Fibonacci level. So went out, we could have done it wider, but we bought the 175, sold the 180, sold the 180, bought the 185, $5 wide spread. We could have made it much wider, see where it was trading. But by going further out of the money, we made it super low risk. So total cost of the trade was 40 cents, okay, or $40. And then the potential profit spread with the $5, 500 less 40. So potential to make 460, which would have been 1,150% return. Risk $1 to make $11.50. Okay, so here you can see it right there. It says max loss, max profit, 460. So that's your potential. And if you get it totally, that's why we call it lotto trade. We try to get these down to, 30, sometimes 20 cents to 40 cents. And then if you lose it, that's your lotto ticket. You lose your cost of your ticket, but you have a potential for the big payoff. So here's where it went out. This one was amazing because it almost went out exactly to the penny. Look at that. So this was back, like I said, two weeks ago. So we set it up on a Monday, the 15th, and this was option expiration on the 19th. This thing's nailed it perfectly. Now, they don't always do that, but this was a really exciting one. So this went from 40 cents or $40 up to $491 or $491. So here you're up $451. If you did one contract, you're up 451. But if you did 5 or 10, you can do the math. That's over 1,000% return in 5 days. So very, very cool, fun trade setup. And our members love to do these trades. So here's one more way that you can use these trades strategy. And this is for hedging. This is what we call kind of what we call hedge trading management, where you can really do some creative things. And so this is a hedge that we hedged into a long put debit spread into a free trade where we had zero capital at risk by doing this adjustment. So this trade was starting out, we're looking for a downside move. And so we set this up just as a put debit spread. So really good risk reward. So it was a debit spread on the 28th, it was trading at 365 right here. Right there, that fib level is coming in at 618, was starting to break down. And then we were targeting down here to this area in here. So this is another area of support resistance going back, way back there. So we were targeting this area down. Our momentum indicators were pointing down. So we had a directional move to the downside. So the trade started out on the 28th. It was trade 365. Now we had a big move down here on the 1st of October. And that gave us the opportunity to adjust it, make it a hedge, where we sold a bull put credit spread and brought in all the debit costs that we had on the original trade, and even at more credit. So we made this into actually a free trade, no cost. So when it got down to 354, so I'll go through and show you. And then we closed out an expiration for max profit was traded at 359.67. So let me pull that up and we'll go through the next step here. So here's the QQQ trade one. I will call it the original trade on the 28th, was long the 6 October 364, put short the 360. All right. So really nice put debit spread. So total cost 121 on the debit cost. So spread width $4 minus your cost of the trade. So potential to make $279 per spread or 230% return. Nice risk reward. But when it collapsed down to this 354 area here, we sold a bull put credit spread and recouped the full $121 of debit, and actually recouped more than that and made it a total free trade. So infinite reward, basically. So on the trade 2 was right here on the 1st of October, collapsed down to 354. So at that point, we sold the 354 put, bought the 350, $4 wide bull put credit spread, brought in $141 credit. Okay. So that credit offset the debit, and actually we had additional 20 cents credit. So you can see here then on the first one that was done, this trade was at that point up $152 plus that $20 credit. It was up 172. Now on the 7th, it went out actually on the 6th, but on the 7th, that shows you where it is on expiration, actually the next day to show you the max. It went out trading at 359.67. So this was a max profit. It was inside of that profit zone. That's what we call a put condor. All right. So we had zero risk. So this was a max profit of $420 on zero risk. So you can see the original debit spread was put on $1.21. That had the max profit of that debit spread of got out at $4. So max profit there. And then when it collapsed down, we sold the bull put credit spread, brought in 141. That went expired zero. So there's your trade profit from those two parts of the spread. And so it went out with a max profit here of $420. So that's the really cool thing about it. Now, I thought I'd show you one more trade that we're looking at. You might want to follow along for this week into next week, but one that looks kind of interesting and not right set up yet to do it, but here's one that we're watching right now on Tesla. Okay, so just to kind of give you an idea. So Tesla here, this is my trading model that I use with momentum. I won't go through too much on that, but here's Tesla coming in up here to this 382 retracement. So let me put this on a weekly and I'll show you what we're looking at. This one we're following. We're not going to probably do it. We'll look at it towards the end of this week and see if we want to, but there's good potential for Tesla to possibly push towards this 230 area right here. This is a weekly 150 period moving average. And then we've got all this, what I call price resistance area here at 230. So there's a good potential for 230, which we call that a pin. So here's the deal. So here's what it would look like. And this would be a lotto trade. So if you did that, you could even do it now. But here's what it would look like. So if you wanted to target this, you could go out and you can see Tesla's trading right now at 217, right? So it's got 230 to the upside. So if we look at the expected move right here for next week, you can see that the 16 June, this is the monthly expiration, has the expected move is about $17. So, 217 plus 17, you want to look at that to see if you're within, kind of a normal standard deviation that would actually be something that you could do to make sure it's realistic. So 217 plus 17 would actually put you up to potentially 234. So that definitely works. So 230 would be our target. And so what we could do is a butterfly, call butterfly. And here I just kind of set it up before I came in. If you wanted to do it, you could get that trade on right now, probably tomorrow when it comes in, probably maybe $35-40. Now I'll probably look to wait towards the end of the week to see what the direction looks like. But look what's your potential profit here. So this is a $5 wide spread. Okay. So $5 wide spread, 500, which would be $500. Let's say you did this for, make it easy math, $35. Okay. So if it went out perfectly there, that's your max profit. So 500 less 35 minus 35, you'd make $465 if you nailed it perfectly on your risk of 35. That's a 1,328% return. But here's the beauty of it. So let's say it didn't get to exactly to 230. Let's say it goes to 230. Let's say it overshoots and goes to 232. 232. Let's say it overshoots and goes to 232. So I can just look at my analytics and I'll just put this to 232. If it overshoots, 232 or I got that backwards, 232. Okay. And then if it goes there, let's say it gets to 232 next, not the 16th, but let's say it gets there on the 15th. So if it got to 232 next week on Thursday, the 16th, this would be up. See, it's only up 78 cents. So the trade, that's why it's a lotto trade, because look at see all that black area, that's the potential profit from selling that volatility and time in there. So, but then the next day, if you're getting up to the, if you're up to 232, this is not right. Market's closed, so it's not giving you good numbers. But if you get up to 232, this would be up right here about $108. Okay. And if you got up at the end of the day into expiration, this would be up 458. But if you got up see this teal line, you just hover over that. So let's say on the 16th next week, let's say it only got to 220, let's say it got to 226, this would be up $140. So it's just a really good, creative, crazy, fun trade to set up. And I just wanted to point that out as something you can follow this week and see if it works out or into next week. So if you'd like to learn more about how to master these high reward, low risk option strategies, here's a really great deal that I've got for everybody here today. If you'd like to take advantage of this, here's the link. Let me make sure that you've got that. And if you could put it in for me, John or Rod, and let me make sure. Here it is. Currently, it's powercycletrading.com. And then it's /trade one. You can see it down below there on that screen. It says trade one. So use that link there. And you should be able to click on it or copy it and paste it. And yeah, so put that in if you don't mind. Let me put it in one more time. So this link should be good to go. So you could just click on that, pull it up, and that's going to give you everything I'll show you here. So the value of this, you're going to get 6 additional bonuses. But this is a course that I'm just completing. Actually, I haven't finished. I'll finish this course tomorrow night. So this is a course that I started this past Saturday. So this is going to be a 6+ hour recorded course on demand for you on just specifically the butterfly long condor. All right. So actually, like I said, I'll be finishing this up tomorrow night. But if you go to my website, powercycletrading.com, this course is offered at $397. But you're going to also get these additional bonuses. You're going to get my course that I did on start trading options today. So if you're just starting out, this is a great course to kind of get you going. So that's the value of my website, $197. And then I'm going to give you a 30-day trial membership to my trading club, which is $97. If you stay on, that's $97 a month, or you can do an annual membership. And you can start this whenever you want. You can start it after you finish the course. Just let us know. Then we'll do a follow-up Q&A, which you'll get a link to on that. So you'll have a live follow-up Q&A, which will also be recorded. So come in and ask questions. Then I'm going to give you what I call my How the Pros Use the Greeks as an option guide of just another option guide of what the Greeks are, how they work, video and PowerPoint on that. And my complete option strategy manifesto of 15 other option strategies in the Greek Power Tool Guide. So that's everything that you're going to get. So you'll get the master's course on the butterfly condor. So I'm just completing that. It'll be about 456-page training manual of the entire course, step-by-step blueprint of the butterfly condor, how to use it for income, profits, non-directional trades, hedging, and more. And here's kind of what we'll cover. So part 1, I covered in the course, just the option Greeks that are really important to make these things work on the butterfly condor. Again, these are long condors, not iron condor. And then the theta decay, how that works, the impact that it has on a butterfly and long condor, volatility impact and importance of that volatility crush, what we call that. And then how option pricing works to understand the effects of time and volatility on your price of the option. And then a big part of the course is using Fibonacci, what I call price target mapping, and this in standard deviation analysis to give us our price targets for the butterfly, either up or down. So this goes through in great detail how I do that using this kind of a process that I put together. So that's covered in the course. And then let's see here. Let me get rid of that. And then part 2 is we get into all the different variations. So in this part, go through every variation with examples of how they are. So how, why, and when to use the long call or put butterfly, how to use the wide wing butterfly, a broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So every variation is covered in the course. And then you pick out the one that you think you like the best or see exactly how they work so you can fall back on them. So that's a look there. And then what are the best option timeframes to use? Should you go out, 2 weeks, 3 weeks to capitalize on the butterfly? What stocks or ETFs or index options are the best, or even futures are great for butterflies. How to structure setups with returns of 10 to 1 or higher. You saw, one there just on Tesla, which is over 1,000%. That was one that we set up 2 weeks ago. How to profit from option volatility correction, theta decay. How to trade what we call a monthly expiration. That's those pinning trades. So this is 12 times a year you can do these types of pinning trades, which potentially offer you those lotto setups. Pinning, based on price target setup analysis, using unusual option activity and Fibonacci, go through that, how we select our strikes that we want to look at for a pin, and then go through the long condor. So the major trade advantages of the long condor, which not like the iron condor can give you returns of 100, 200, 300% versus a negative risk ratio. How and when to use the long condor in your directional trading to control risk and for hedging. And then a really big part of the course is dedicated to hedging. So I call it progression of hedging, take you through all the different progressions, and then how to use the butterfly long condor to hedge a core position, and then how to use that butterfly and condor to hedge vertical spreads like a vertical debit or vertical credit spread. So step-by-step checklist, when to put them on, take them off. And then another big part of the course, execution risk management. So, what is assignment risk, how to avoid that, expiration risk, auto exercise. And then you get a nice trading library of trades that you can go back and review, to help you learn. So here's a little feedbacks from Alicia. Said, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like it. Wish I had found you sooner, but I found you now. Thanks again. And this was Pam. She had lost so much money on credit spreads. Excellent class, Larry, as usual. You under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money on doing credit spreads. So here are your bonus packages for everybody. So just use powercycletrading.com/trade1. And along with the course, you're going to get my option trading, start trading options today. I did this back in February. So it's a kind of an intermediate beginner's course. It takes you through the benefits of options versus stocks, puts and calls, what they are, mastering puts and calls, how option expiration works. And I take you through 3 different strategies, actually: covered call, the protective put, and also the debit spread in this course. So that's a bonus. And then you'll get one 30-day trial membership. You can start whenever you want to my trading club, which gives you access to my virtual trading room, open each and every day from 9:30 to 10:30, Monday through Friday. Do a daily trading videos after the market close. So you'll have that. And then members trading video are archived. And then I do weekly Q&A, usually every Tuesday, live, and these are recorded in the Trader's Educational Vault with a lot of good educational stuff. And then for my website, you can get 60% off anything on the website that I have. All my indicators, I'll show you real quick. So if you go to my website, powercycletrading.com, and you go to courses, trading courses or boot camps, click on that. Any of my courses, once you're a member, you can get for 60% off the price. So here's one I just did recently, Ultimate Option Guide course. And this one is, listed here for $597. So you get 6% off that. Breakout reversal course, insider trading, technical trading profits course. Here's selling options for income, profits, and hedging. Calendar, counter diagonals. We do a lot of those. This course is a great one, showing you calendar and diagonals. So you get 60% off that. Earnings, we do a lot of double calendars. And here's the butterfly course that I just completed. I'll be completing tomorrow. So you'll get that, but you're going to get it tonight for $197 with all the bonuses. And then if you want any of my trading software, click on that. And then all these different things, my scanner, my custom indicators, all that good stuff there that I've designed and developed, 60% off. So get a lot of great stuff here with this package today. And then we'll do a follow-up Q&A, which you'll be sent out a link to. So help you, more questions on the course or anything else you want to discuss, please come in. And then how the pros use the Greeks. So just a 60-page option guide with videos on the Greeks, standard deviation, delta, trading probabilities, a lot of good stuff there. And here's another really nice one, 15 option strategy guide. So, if you've always been wondering what's a back ratio spread or what's a short butterfly, what's a straddle, things like that, this will take you through the trade construction and then when to use. And so a Greek options guide. So tell you what delta, gamma, theta is, you can put it on your desktop. So that's everything. And if you want to join us, please do. I'd love to have you as a member, or just come in and try us out 30 days and see how you like us. So hope this was beneficial to everybody, and thank you so much for being here.
So I have no idea how you can over deliver on top of all this, because this package is just enormous. You just kept going, and I was like, really? Where's
Well,
is it going to be more? It's only $197 for all this stuff. Wow, that's amazing. Let me ask you a couple questions if you don't mind. Can you tell me about the follow-up support Q&A? Is that like we all meet together and then you answer our questions yourself? Do you have somebody who does that? How does it work?
No, I do it all. So yeah, we'll send you a link, and usually the Q&As will usually have every Tuesday, 11:30 Eastern. So you'll get a link to that, and then you'll come into our webinar on that, and then you can just ask whatever questions. I'll take your questions. And then usually, I'll go through various things we're looking at currently on the market, trade setups, things like that. We're looking at, maybe it could be a Tesla butterfly or something.
Oh, okay.
So just come in, and if you have a specific question, just always ask, and I'll get to your question and answer your question.